Welcome to From the Bottom to the Top. I am your host, D. Swain Jr. And today I have a guest with me, and it's such an honor. I have Sarry Ibrahim. Am I saying that correctly?
Yeah, Sarry. Yep.
Sarry. Okay. Thank you, man. So thank you so much for being on the show. Thank you for being here. So first, man, just tell us a little about yourself. So my viewers know who you are.
Yeah. Thanks for having me on. I appreciate it.
You're welcome.
So I'm from Chicago. I'm a financial planner. I president of Financial Asset Protection. We're a financial services firm. We help mostly real estate investors and business owners grow, save, predictable wealth on a guaranteed basis, also on a tax-favored basis too. We've been doing this for about 5 years. And again, mostly specialized in real estate investors, business owners, and the core of our business, Derek, is mostly the infinite banking concept, or also known as the bank on yourself concept. So that's who we are, and that's what we do.
That's cool. So like, do you guys work with realtors as well? Like, what kind of like savings are you guys kind of helping people with doing?
Yeah, absolutely. We work with a lot of realtors, a lot of self-employed people.
Okay.
So pretty much what we're doing is we're setting up policies through the infinite banking concept. And what that means is, for the listeners who have no idea what I'm talking about when I say infinite banking, that means that we are using dividend paying whole life insurance mainly for the cash use, for the living benefit part. And to kind of take a step further backwards, whole life insurance has two parts. It has two main purposes, or two parts. One part is the cash value part, and the second part is the life insurance part, like the actual like death benefit part. Of course, when it comes to business ownership and liquidity, we need to focus more on the cash part, the living benefit of the policy. And that means that there is cash value in the policy. It does grow at a guaranteed rate every year. You get dividends from the insurance company. Although dividends aren't guaranteed, we only work with insurance companies who have been paying dividends for over 160 years. So this is not something new. It's been around for a really long time. We just kind of joined the Bank on Yourself organization and figured out, like this would help a lot of people. And then we didn't invent this, obviously. We just kind of put it together. This would help. And I've been seeing a trend with a lot of real estate investors because of the liquidity aspect, and because you're still able to grow your money at the same time while using it.
Wow. And so you can still, so is kind of similar to a 401k, you would say? And
yeah,
so
in the sense,
go ahead.
Oh, sorry,
go
go
ahead. Oh no, I was just going to say, but is this something that's kind of different from a 401k? It sounds like you can pull money out even though you put money into even though, like a 401k, that's something, the money just sits there.
Yeah, so it's in the sense of, saving money, it's similar. Like you're putting money away, and then as you're putting money away, you're putting it into this whole life insurance policy. The insurance company, it's a for-profit organization. So what they're doing is they're using those premium dollars to invest in other things. About 60 to 80% of their money is invested in the bond market. 20 to 40% is in real estate and in private loans that they charge interest on. So pretty much the insurance company is making money with that, and then they're giving you back like a return on your money plus interest plus dividends every year. And now you have the ability to grow your cash value. And then let's say, for example, you've been doing this for a couple of years now, and you have $100,000 in available cash use in the policy. That means you could borrow up to 90% of that. But let's say you're a real estate investor or a realtor, you come across a business move you need, and you need $50,000 from it. You can go to your insurance company, borrow $50,000 from them, leveraging your $100,000 as cash value. You wouldn't be subtracting $50,000 from $100,000. You'd simply be borrowing against it. So what happens then is you now have like this personal loan with the insurance company, and you borrow at like 5% simple interest, and then you're going to earn still interest on your money as if you never touched it. So in other words, you have this pool of cash that earns interest, and when you want to access it, you borrow at a loan against it at a smaller amount. So this way you have an arbitrage. You end up making money in the policy over time through the compound interest and through the dividends. And let's say you make money with the $50,000 you borrowed, you make an investment on that, a profit on that. So now your money just did two things for you. You made money on the outside of the policy and within the policy.
Wow. So where's something like this? Like where can my people or my viewers or someone like myself can, find these services in this program?
Yeah, definitely. So you want to research infinite banking concept. You want to research the bank on yourself concept. And there's a couple of things you want to note. This doesn't work with all whole life insurance companies out there. There are some limitations. Number one, it has to be a mutual insurance company. It cannot be a stock owned insurance company. Stock-owned insurance companies are owned by shareholders. Mutual insurance companies are owned by the policy owners. So it has to be a mutual insurance company because mutual insurance companies give their dividends and profits back to the policy owners instead of giving their dividends and profits back to shareholders. So it must be mutual. And then number two, it must be a non-direct recognition loan company. And what that means is non-direct recognition loan. What that means is that in the example I just mentioned with borrowing, you have $100,000 in cash value and you borrow $50,000. What that means is the insurance company will not recognize your loan when giving you dividends and interest on your money. So in other words, they'll still give you dividends and interest on your entire $100,000 as if you've never touched it. There are some companies that are direct recognition loan companies, and they'll recognize that loan and they'll reduce the dividends and interest they're paying you because you have an outstanding loan. So it must be non-direct recognition loan company from a mutual insurance company. Okay.
So like for an investor, just for like an example, just to kind of help someone, let's kind of paint a picture. What, so if someone like I say, if I wanted to invest in a property, like what necessarily would I be kind of giving you guys some of my money to get like, or let's say am I giving you 50,000 to get, more for the investment, or how is this working on the investment side of being an investor working with you guys?
Oh yeah, good question. Yeah, so there is a capitalization period, and what happens is that when you're investing into the policy, when you're saving into the policy, every dollar that goes into the policy is doing two things. A part of it is going towards the cash value, and then a part of it is going towards the actual life insurance. So let's say, for example, you're putting in like $10,000 a year, every year. Okay. Of that, a portion is going towards the cash value, and then a portion is going towards the whole life insurance. Now, for it to be the infinite banking concept way, it has to be structured properly, meaning that you can't have it all, every dollar going into the policy going in only towards the life insurance, because your cash value is going to be too small then. So you need like a healthy balance between the cash value and the death benefit. So for example, if I'm putting in $10,000 a year, about half should go towards the cash value and then half towards the actual life insurance. So over the course of like a couple of years, I'll have, 5,000 in year one, and then there's going to be exponential growth later on. In the first couple of years, that's when the fees are typically the highest for the insurance company, but the policy becomes cheaper to maintain, and then you start to earn more compound interest on your money. So let's say by year 10, you would have paid about 100,000. You would maybe have like $130,000 in available cash use. Then you would be able, because now the interest and dividends have added up. So at that point, you'd be able to borrow 90% of your cash value. Technically, you can start borrowing at any point. You don't have to wait a certain time. But if you are a real estate investor and you want to start like, ideally like, $100,000, that sounds more feasible for a real estate investor. It could be less than that. It doesn't have to be 100,000, but that's pretty much like a good number to think about. Again, we could do 50,000, but again, there is a point that you have to capitalize. So you can't put in $10,000 in the policy and then go borrow $50,000 from the insurance company because you don't have enough cash value. You can only borrow up to 90% of the cash value
that you put into it.
Yeah, exactly.
Okay, cool, man. So can you tell us how did you get into this? What got you started into this infinite banking?
Yeah. So I was working for a couple Medicare companies. I was a Medicare broker. I still am, but at that point I was a full-time Medicare broker, and I was helping people who were like 64 years old, retiring from their companies, merging onto their own Medicare plans. And during that time, one of my clients asked me if I could do research for him on life insurance. He said he had heard about something with life insurance that built cash value over time. I had no idea what he was talking about. So I went to Amazon. One of the ways I like to learn is I like to go to Amazon and search for books. So I went to Amazon, searched for books about life insurance, and then came across this book called The Bank on Yourself Revolution. And the Bank on Yourself Revolution, it's about the bank on yourself concept. It's about using whole life insurance. And then I later learned that that's based off of the infinite banking concept. So it's the same thing. The infinite banking concept is the same thing as the bank on yourself concept, just different trademarks, different marketing behind them, different branding. But it's based off the infinite banking concept. So that's by Nelson Nash. That's who invented the infinite banking concept. And he has the book Becoming Your Own Banker. Wow. So I read those books, and then the Bank on Yourself company, they have an 8-week training program where you can go through if you want to become an agent of theirs. And I went through that training program. I own my own Bank on Yourself policy, and now that's what I do full time now. I help a lot of real estate investors, business owners build these infinite banking policies, mainly for the cash use, and then mainly for the security, so that way they can actually build a retirement and not have to wait until they're 60 or 70 years old to access that money.
Right.
They could recycle that money and access it in the meantime between now and retirement.
Right. And is there any type of limitations, like what you can do with the cash that you put into this insurance?
Awesome.
Mutual insurance.
Awesome question. Yeah. So there are no limitations on all what you could do with this money. You could use it for real estate, for your business, for your home that you live in, vacation, whatever you want. There are no restrictions on what you could use that money for.
Man, that's great, man. Because that's something I think we definitely, not even just real estate professionals, people that are entrepreneurs. Because I know even my brother and myself, we manage our own accounting. We're not, we're not in a position to where it's so radical where we need to hire an accountant, but we're relying on ourselves to have put that savings away and not touch it, so so I think what you're doing is a beautiful thing. And are you on social media? Like, how can we find you? And if some of my viewers have any more questions, where can we find you specifically? I'm
mostly on LinkedIn. And if you go, the way you can get on my LinkedIn, the quickest way is if you go to my website, finassetprotection.com, FIN, assetprotection.com. That'll link you to the LinkedIn page and everything else. And you can find more podcasts and more content out there. Okay. And then the two books I recommend for the listeners to read if they like to read books, Becoming Your Own Banker by Nelson Nash, and The Bank on Yourself Revolution by Pamela Yellen. Those two books will change your life.
So how would you position like someone that's just, because I'm sure you as a salesman or pitching your business, how do you kind of differentiate and letting people know if someone just says, well, hey, I have a 401k or I have this type of savings that's just, it's been working for me, what is more of the benefit of going this route versus like an IRA? What is it? What are the benefits for using your service versus, the traditional way?
Yeah, really good question. So pretty much I would break it down into six parts or 6 elements, and I'll go through each one in a second. So for numbers 1 through 6. So number 1, fees. So you want to ask yourself with whatever saving you're doing, whichever investment you're taking on, is how much is it going to cost you to maintain or service this account? Typically with IRAs and like 401ks and other like qualified plans, the fee structure on those are like 1% to 2% every year, and that can eat up a lot of your gains. And it's not to say that that's bad. Don't do IRAs, don't do 401ks. I just want the listeners to think about the fees, like how much is it going to actually cost? And you do have to pay the fees out of your account, whether they go up or down. So you're always like on the hook for that recurring 1% to 2% fee every year. So think about the fee. How much does it actually cost to maintain this? The second thing are limits, contribution limits. So with IRAs and Roth IRAs and 401ks, a lot of these plans, they all have limits. Like for IRAs, it's like $5,500 a year or $6,000 a year. For 401ks, it's like $20,000 a year. So you have to consider these limits, because you reaching out what if you want to add more than those limits? And it won't necessarily be feasible just to max out that, and then just to max out all these qualified plans, when you can allocate it somewhere and earn more compound interest on it. So the limits are another aspect to think about. The third, liquidity, being able to use this money. If you have an IRA or 401k, if you want to touch that money, you have to wait until you're 59 and a half. And if you access it before, then there's a tax penalty. And I'll get more into the taxes later, but there's a penalty. In other words, it's not easily accessible. You can't easily access that money. Number 4, risk. 401ks, IRAs, a lot of these qualified plans, the back end of them is in the stock market. So when things happen in the stock market, there's volatility that happens. They're affected. They're the first that are affected, because they're easily exposed to the markets. And then number 5, integration. What I mean by this is you want to think about, can I put money into an investment and then put it into like another investment at the same time? Could I have that money move around in different places at the same time? With IRAs and 401ks, you can't do that. You can't put money into a 401k and then take money out of the 401k and then put it into real estate. Here's the thing though, you could do a 401k loan, but then that's a whole separate topic. When you do a 401k loan, you still have the market risk, you still have the tax component, which is double taxation. But I don't want to get too far into that. I want to just the listeners to know that you can't do more than one thing with these investments. It's either I do it in an IRA, or I do it in a 401k, or I do it in real estate. but with and I'll get more into this later, but integration is a huge component. And the last part is taxes. With IRAs and 401ks and other qualified accounts that people use, they are pre-tax vehicles, meaning you're putting money in, deferring from taxes for the later years. But the problem though is that it's not guaranteed that tax rates will go down. As a matter of fact, I think, in my opinion, tax rates will go up in the future. You know, look at this year, just 2020 alone. It's been the craziest year. The government spent so much money on stimulus checks and PPP funding and EIDL loans. They're going to get a way to get that money back. Aside from the Social Security budget, aside from Medicare budget, all these budgets are increasing. So the government is going to need a way to recoup these costs, and they're going to do that by increasing taxes. So kind of the tax component is super important. With the bank on yourself policy, with these whole life policies, sorry, I don't want to get too far into taxes. I don't want to,
You're good, man.
But pretty much you're converting your money, you're paying taxes on it, putting the money into the policy, and you're in the 0% tax bracket. So you're not affected from these market losses. You have access to the money at any time, at any age. There is no market risk. It's always liquidity. And the fee structure, we don't charge any fees for structuring these policies. We simply get paid from the insurance company. That's how we're compensated. And we only get paid on the first year. That's why in the first, like for example, if you looked at a scale of years 1 through 20 on a whole life insurance policy, usually years 1 and 2, that's typically the most expensive the policy will be. And then over the years, the fee starts to decrease, and then your compound interest starts to increase. And eventually the policy will pay for itself. In like year 5 or year 6, the policy will end up paying for itself. You end up getting compound interest, and it'll keep growing and growing. So you don't have to keep paying fees every single year for somebody to maintain your account. So in terms of fees, liquidity, limits, risk, integration, and taxes, definitely the bank on yourself process, or the infinite banking concept, definitely wins against all of these qualified accounts when you look at it from these perspectives.
Yeah. Was that the last step?
Yeah. Those 6.
No, man, that was and that's definitely a lot bigger, than 401k, because it's completely controlled. You don't get the flexibility and all the things that you guys are offering, and I think that's big, and that's one of the biggest. That's the main reason why I thought this would be a good show, because of what you guys are taking away from the I think the traditional ways are just completely outdated. And so when these new innovative things come about, I think it's good to get out there and to hear about, because a lot of people, even myself, we don't always do the research. We all just think, I'll just put it in my savings until I figure it out. But then, things do get carried away, or you do get away from yourself. But no, man. And I definitely agree with the taxes, man. I didn't even think about, like this, as much money as they dishing out and trying to keep the economy afloat, we're going to have to pay for that. Or at least, the regular working class is definitely are the ones that's going to have to pay that back. So I love how you spoke into that, because we don't think about when we invest into these 401k things, it's just okay, I'm putting money aside, but you don't even realize that you're not even paying taxes on it. Because that was one thing, I'm like, oh, deferred, I only have to pay taxes. They take the money before they take taxes, which I thought was cool until I had to withdraw it. until you're like, oh wow, like you get hit with you think you're getting 5,000 when in actuality you're only getting about half of that.
Yep.
So I think that is definitely a good dope thing that you guys are doing with the I keep the mutual insurance. Infinite banking. So I think that is amazing, man. Thank you so much for talking about this, because I didn't even know anything about it until you introduced it to me.
Yeah. And if listeners reach out to us at finassetprotection.com for a free consultation, and if they say they came from your show, okay, I'll give them a free copy of the Bank on Yourself book. It's like $15 on Amazon, but I'll send it to them via Kindle for free if they schedule a free consultation and they say they came from your show as like a thank you from your show.
Perfect. Hey, you guys hear that? Make sure you guys check that out. Man, thank you so much for doing the show with me. I don't want to tie up too much of your time. Again, thank you so much for the information. Again, let us know where we can find you. Let us know where we can, reach out for any more questions or interests. Yeah,
for sure. Yeah, definitely. Yeah, go to finassetprotection.com and I look forward to hearing from you guys.
Perfect, man. Well, thank you so much for doing this with me. You have
Yeah.
a great evening, and I hope you continue to help people, save their money.
Yeah. Thanks, Derek. Thanks for having me on. I appreciate it.
Oh, it's my pleasure. Hey, this is From the Bottoms to the Top here with Sarry. You guys have a great day and stay safe and just wear the mask. It's okay. Just wear the mask. All right.